Welcome to the Successfully Retiring from Allstate with Executive Compensation webinar. Today, this is really a guide for senior Allstate leaders, business leaders, that could be directors, executives who are looking towards retirement. And this could be sometime in the next 10 years. So it could be in the next year or two, or maybe you're still 10 years away. And so you're starting to think about retiring from Allstate and what you need to know. This can be a really great start for you. So I'm glad that you're here. I think this is going to be really helpful. We're going to dig through a lot of pieces that really are things that you need to consider as you start to move towards retirement. As most webinars, if you have questions, we want to be sure that you're putting those in the chat. We will answer those at the end of the webinar. So be sure that you put those in the chat. We'll get to those. And then we are recording today's webinar, so we will send that recording out and other resources at the end of this. So you should receive those just in case there's something you want to re-listen to or there's notes you weren't able to grab. So yeah, just a couple of housekeeping items there. All right, well, let's go ahead and get started because we want to make the most of your time. You know, when we think about retirement, we start to think about several different things. And so we've kind of put together an agenda of several items we want to cover today. We're going to review Allstate's compensation and benefits. We're going to talk about looking ahead to retirement, really things you need to consider. We're going to review benefits that are needed and retirement benefits such as your pension and 401k, because especially now that you're retiring, these are benefits that you need to start to make decisions about a little bit differently than you were when you were working. Coordinating your plan for a smooth transition, and then some actionable steps for personal financial planning. So some strategies we see commonly used that also might give you some ideas. And then we'll close up with some questions and answers. We'll answer those questions you have. So when we think about retirement, you know, I think this is a very common goal that people have. I think it's a goal that almost everyone has. Not many people say, I want to work forever. And so, you know, retirement is a big deal and is a big goal. But I think about this a little differently. Recently, I went on vacation with my family, and I kind of loosely call it vacation. You'll understand why here in a little bit. We went on a camping trip, basically over 9 nights. We camped around Lake Michigan and did the Lake Michigan Circle Tour. And I quickly learned that camping, because I've never done this before, so we pulled a camper, so it wasn't roughing it by any means. It was a little bit nicer than that. But what I did notice is that when you go on vacation, usually, and you say, I'm going to Florida or I'm going to Hawaii, you know, you get there and you're like, oh, we've made it. It feels like that's the destination. You've gotten there, and so now you're going to enjoy the sights, the things you want to see, the activities you want to do. But when we were on our camping trip, one of the things that I noticed is that I did not have that feeling at all. And so I quickly realized that when you're camping, you know, going to that first place is not necessarily the destination for us, because we were going to be camping at 6 different places around the lake. But it was more that the entire trip was the journey or the adventure. And so I think about this a little bit more when I was thinking about it. I thought, you know, this is very similar to retirement. It is a goal, and retirement itself, the day you retire, the age you're going to retire, that is not the destination. We're not just trying to get to that day. We're also trying to get to retirement, but also through retirement, really the rest of your non-working years. And so I thought about this, and it just made me think, you know, retirement is not the destination, but it's really the start of a new journey and an adventure and just kind of a next phase of life, what you're going to do now that you're not working full-time every day. And so I really like to help people start to think about it that way. It's very exciting. It can also be, you know, really scary. It can also be a lot of unknowns. And so there's a really big mix of emotions that people can have. You know, I've heard people say that, you know, oh, aren't you so excited? You should be so excited you're retired. But that isn't necessarily the feeling that someone might share. And so then they might think, well, what's wrong with me? I should be excited. There's a lot of different emotions that people can have, and these can really impact or be affected by your plan that you have for your finances. And so to help you retire well and really start that new journey, that's what we're talking through today, so that these Allstate benefits that you've had and now you're considering how to continue using into retirement, that can be a smooth start to a new and exciting journey or adventure. And so just that reminder that that's really what we're talking about today. So we had a webinar prior to this last month that really talked about the employee benefits that you have with Allstate, really in depth. And so this is really just kind of at a glance, just a reminder of these benefits that you've had as an employee: your 401k, your health insurance, the legal plan, stock options and restricted stock, a pension benefit, salary and bonus. These are just benefits that you have available to you. And it was just a reminder, this screen really just to show us that you have a wide variety. You have really great benefits that you can utilize with Allstate. And so we want to be using those the best that you can to affect your personal financial plan. And so I'm not going to go into these in depth today, but you could watch that webinar that we will link to from a month ago, that you could actually get more in-depth information about this, is if this is something that you're starting to consider, or maybe you've just started receiving. So now when we look ahead to retirement, this is kind of how we need to start asking some questions. And some of those questions, naturally, I'm a financial advisor, so I start asking these: do I have a financial plan? One of the things, not only do you have a plan, someone might say, well, yeah, I got a plan 5 years ago, but it's very important to consider, will it last to and through your retirement? That plan, your assets, your income, all of those pieces, are they going to last for the rest of your life? And is that something that you can update frequently? Because life will change. I very rarely see retirees who nothing changes in their plan, whether they decide to move, whether they decide to buy a second property, even if it's smaller in a warmer location, whether they decide to make gifts to their kids or grandkids. There's always something that's changing based on something they decide once they're retired. So it's always a great idea to have the ability to update that financial plan on an ongoing basis, even yearly, just to make sure that the decisions you're making, your plan can still support. That really gives you confidence. It really gives you clarity to know, okay, we can do these things, and I'm confident in them because of how the numbers look. Some other things you want to start to consider that are not necessarily financial is, do you have a plan for your time? So I've heard people talk about, what hobbies or activities do you want to enjoy? Do you think you want to spend more time doing? Have you even considered various activities depending on what your health may allow? I've noticed different retirees, depending on when you're retiring, they have the ability to do a variety of different things. But if your health isn't what you think it's going to be, when we set that goal of retirement in the future, now that we're getting to retirement, we may not be able to do all the things we thought we could. And so it's just something to really think through. I've heard it said, someone was talking about, on day one, what are you going to do? Well, I'm going to go golfing. And they think, oh, I'm just going to golf in retirement. Well, day two, and you show up to the course and you do that day 3 and 4. But by day 5, do you really want to keep doing that? Or do you have the funds to be able to do that? And so these are the things that you really want to consider. What is it that I want to do? And maybe that's a variety on different days. Maybe it's volunteering, maybe it's things you enjoy, building or being active. Whatever that looks like, here's kind of what you want to start thinking about. So this is really just to encourage you. These are the types of questions to start thinking about as you're looking ahead to retirement. Now, when you start to look ahead to retirement, and you've been looking at these things for your working years, but you really need to look at your employee benefits with Allstate with kind of a new set of eyes. This is really a new look at your benefits. And what you're wanting to consider, even with some of these, is, do I still need everything that I did while I was working? And just to give you a couple of examples, when you're reviewing these benefits kind of with this fresh set of eyes, you're trying to think of even things that you may not need anymore. So for example, while you're working, you have disability insurance, you have life insurance. These are some common ones. With Allstate, you have these. And so now this disability insurance, we start to say, okay, well, do I need this? It's very common that people say, here's the things that I had while I was working. How am I going to get those when I'm not working? But if you think about it, disability insurance is really only something you need so that you're ensuring if you become unable to work, now you continue to get a paycheck for that time period until you're able to go back to work. So now if we think about someone who's retired, you're not worried about becoming disabled because now you've already saved those funds that you're going to need in retirement. You're not working any longer. So there's nothing to insure. There's no income that we need to insure for. Very similar to life insurance. Now, this is why I say some people may still need these types of benefits. And so you really want to think about this. So, for example, life insurance, this is another one that, you might have as an employee benefit, or you do have as an employee benefit, but you also might have this as a policy outside of Allstate. And so now you have a policy that you say, do I need to keep this? This is another common question. Now, life insurance is very similar to disability. We have this insurance to provide for our family if something were to happen, if we were to die, before we've saved money for retirement, for kids' college education, before paying off our home. And so now this life insurance gives us this benefit. If I were to die before those things are done, I know my family is going to have that money to be able to do those things. But now that I'm retired, I've saved up for those things. I've saved for retirement. I've possibly already paid for college education. Maybe I'm already starting to fund grandkids' education or gifting, things like that. And so now I don't have as big of a need for life insurance as I did when I was younger. However, you might be someone who you say, well, this life insurance policy that I have actually could pay the taxes on my estate, or because I have a higher net worth, or maybe I want those funds to be given to some of my beneficiaries. So this is where you may need these benefits, or you may want them, while other people may not. And so this is where you really have to review these based on your specific situation. But that's just an example of how you want to be thinking about the benefits that you have. Now, you also want to consider benefits that you are going to be taking into retirement with you, and how you're going to use them. So that is your pension, your 401k, your HSA. Up until this point, you've really been saving money into them. You've been wanting them to just continue to grow. You may not even look at them very frequently because you just log in every now and then and they're doing their job. But now we have to start looking at these as, okay, how do I need to use these funds? And so this is something that we're going to dig into, that we have to start considering. So it's just that new look at the employee benefits that you've had all along. So we're going to start here with this 401k retirement savings, and we're going to talk about one of the specific choices that you really need to make depending on what you have. So in this first example here, we can see this is a traditional 401k. This is for someone who's put money into the 401k. You've received, matching contributions from your employer. Once you retire, now you have the ability to decide, do I want to leave this in Allstate's 401k? Or do I want to take it with me and roll it over into an IRA? And so what happens, and the reason that this decision actually really is important, is there can be a difference depending again on when you're going to need these funds. Let's say that you're someone who has saved money outside of your 401k as well as in your 401k, and you say, the day I retire, I don't need to take money from this. I'm going to be 59 years old when I retire. Okay, well, one of the specific things that's different with these two options is if you decide to leave your 401k at Allstate, for example, and then you'll just take money out when you need it, then you can take money out before 59 and a half, and there is not an additional 10% penalty. Let's say you decide, or you just make this decision to roll it into an IRA. You weren't aware of this. You move money into an IRA, and now you need to take some money out. You're still age 59. Now you're going to have a 10% penalty on those funds that you've withdrawn up until the age of 59 and a half. So it is something you do need to be aware of. That 401k can give you a slight benefit depending on when you need these funds. Now, I have seen employees when they retire, for example, that they weren't sure if they were going to need some of those funds. For example, they were planning to buy a car. And then, so they said, we decided let's keep, maybe 50,000 in the Allstate 401k, but let's roll over the rest of the funds into the IRA because we know that we really don't need any more than that. They were very close to 59 and a half, but we wanted to leave the ability to use those funds if we needed to, and then roll the rest over. So that was something that you can also do. You can roll most of it, but keep some there that you think you might need, just so that you don't incur that penalty, that 10% penalty prior to age 59 and a half. So that is something to be thoughtful of. And then once you're 59 and a half, you can roll the rest of those funds into that IRA because you no longer really need that 401k. That's one example of how you can handle that. Now, let's say someone who has a Roth 401k, again, you have two options as well. You can leave that at Allstate, or you can roll that over into a Roth IRA. Now, one of the things from a Roth IRA that you really need to be thoughtful of is that same 10% penalty. You may have that, but it depends on whether those funds you're withdrawing are your contributions or your earnings. So, to explain this a little better, someone who has been working at Allstate for, let's say, the last 10 years, and they've been putting $5,000 a year into their Roth 401k. All of those funds you've been putting in have started this 5-year clock of, okay, now I have a Roth IRA for 5 years. You need to have that Roth IRA for 5 years, the Roth 401k for 5 years to be able to then pull those funds out. Now, all of those $5,000 that you put in over the last 10 years, that's $50,000 that you have added to that account by your contributions. Now, that $50,000, as you deposited those funds, they also were growing because they were invested. So let's say that account is now worth $100,000. You can take out of that Roth IRA that first 50,000 because that's just your contribution. So you can take those funds out. But if you were to start to take more than 50,000, now we're getting into the earnings, the growth of that Roth IRA. And so this is where you have to make sure that you're past this 5-year window and that you're also past that 59 and a half. So this is where you just need to be careful and know how much you're taking out, how much is contributions, and how much is earnings, whether this is for your 401k or your IRA. Now, one of the interesting things that, and this is some of the planning that we say you need to be doing ahead of time, is if you're going to roll your Roth 401k out into a Roth IRA, it's a good idea if you're able to go ahead and open that IRA and the Roth IRA early enough, open those accounts. So whatever custodian that's going to be at, if that's Charles Schwab, you want to open those accounts there so that you're going to be able to use those funds when you need. So back to that 5-year rule example. You would want that Roth IRA, for example, if you're able to contribute to that or do a backdoor contribution, if you can start that 5 years prior, or those contributions you've been making into your employer plan, that's what you need to be aware of, is really that timeline of how long you've been contributing and how long those funds have been there. So that's something that you just need to be paying attention to. Again, this is some of that planning ahead that you need to be sure that you're doing so that, again, you can use that money when you need to. Now, one of the other things that's unique to your 401k is that you can own Allstate stock within your 401k. And we talked about this in a prior webinar, but that Allstate stock that's owned in your 401k is very unique because it can come out of your 401k and be put into a brokerage account, and now you pay tax at capital gains rate instead of income tax rate. And so what's really important is, when you go to retire and you decide, I'm going to roll over my 401k, what question you will get from a custodian is, okay, what do you want to do with the Allstate stock? And they will ask you, do you want to roll that out differently? Do you want to put that in a different account? And you want to keep that separate from the rest of that 401k, those contributions and earnings. And that's because you're going to get better tax rates, lower tax rates on that stock. If you were to sell it, you're only paying capital gains at those gains, on the gains of the stock for the time you held it at those capital gains rates. So it's very important. We're going to talk about other things you can do with that stock as well. But this is just something, when you have this decision of what to do with the 401k, you want to be sure that you're planning ahead. Again, opening that brokerage account, that's a taxable account that now the funds in there, the gains that they have, you only pay tax on the gains. And so that's different than your IRA and your Roth IRA, where with those you pay tax as the money comes out of those when it comes out, and you pay it at income tax rates. So it's very important to know the difference and to know that each of these pieces need to be handled differently and what you can and can't do with them. So again, this is a 401k that you've just been saving money into. You've been receiving employer contributions and it's been growing for years. But now, as you're considering retiring, or as you're retiring, you have to start to make some decisions, and you need to know what you're doing with these funds. and when you're going to need them to make the best decisions. Now, I just want to review because you might be someone who says, I'm going to leave my 401k plan at Allstate. I'm going to leave that account there. I don't really want help investing it. It's worked for me fine there. Some things that you do want to know if you decide to leave it in that Allstate 401k for as long as they will allow you to, is you do have options of target date funds, asset class funds, or just self-directed where you can choose from anything. Now, these target date funds, what's interesting now that you're in retirement is that this is where you typically say, I'm investing and based on a retirement date of this year. So let's say you're going to retire here in 2025, for example. And that target date fund says, okay, we're going to get more conservative as we get closer to the year 2025 or whatever year that is. That's what happens. It gets more conservative as you get closer to that retirement year. So your funds are safer the closer to retirement you're getting. Now, what's interesting is, but you've retired and you've set this to this conservative allocation. So even if you're leaving it there, you need to be thoughtful of, well, now how do I want to invest these funds? Because you may need to set it to a new target date so that it's not too conservative or too aggressive based on, again, when or what you need to use these funds for. Asset class funds where you may just say, I want this amount in a large cap stock or a bond fund. Again, these just revisiting what you want these to look like. And then self-directed where you can choose from anything. But again, even if you're leaving your 401k at Allstate, it's very important to, again, relook at these options that you have. But one of the nice things with Allstate is that you do have these options. You do have choices, good choices to choose from. Now, I talked a little bit about that Allstate stock that you own inside your 401k. And what this is called is net unrealized appreciation. And so what's happening here is you own or you buy stock in your 401k as you're working at Allstate over the years. Let's say you've worked there 10, 20, 30 years. You just continue to buy stock inside your 401k, maybe in smaller amounts. But it's grown, as you can see here, just this chart of Allstate stock over all time. You can see that it has grown over time. And so what happens is now this Allstate stock has grown, so there's gains in it. And that's a good thing. That's what we want. But really with net unrealized appreciation, what you're doing is you're saying, okay, now when I move this out of my 401k, I'm going to move it to a brokerage account. So I'm only paying tax at long-term capital gains rates rather than ordinary income tax rates. And that's what's important. That's really what you're accomplishing. So I just wanted to explain that's what this is called. That's what that piece there that you're going to be transferring out, that Allstate stock specifically to. Now here's just kind of a look at these different brackets. So when I say now you're going to pay tax at these capital gains rates versus paying them at federal income tax rates, what's interesting is you'll notice here the maximum that you could pay in your tax bracket for capital gains is 20%, or maybe you'll only be paying at 15% once you're retired. So those are nice low brackets compared to up here in income tax brackets. For example, you could be paying 32, 24, up to 37% in income taxes. And so you can see very quickly, you can get into a 22% income tax bracket, even in retirement, when you add up your Social Security, maybe pension, IRA distributions. And so what's really nice about this was when you pull out that Allstate stock that has that net unrealized appreciation, now you're only paying these capital gains rates, and that's really valuable because now again we're paying less in taxes. Now that one move right there, let's say you did not know that. If you didn't know to take that stock out separately and you just rolled it over with the rest of your 401k, you could be paying higher taxes versus these lower rates that you could pay if you move that out separately like you want to do. And I'm going to show you something later that now that there's an option where you could even not pay anything in taxes depending on how you use it. These are the types of things that, again, what we're trying to do is just help you keep as much as possible in all of these benefits. All right, now when we start to talk about Allstate stock compensation, really what we're doing is we're trying to leverage the compensation that you've been given. And we talked a lot about this in our webinar last month. Really at this point in your plan for retirement, you've likely developed a plan for when you're going to exercise or sell any Allstate stock that you're still going to have and that will vest and be available for retirement. So this can include your stock options, restricted stock. And so this is where you really want to have that plan. So if you don't, it's very important that you know what are the taxes that are going to be owed on that depending on when it vests or when I sell that. Now, one of the pieces in the planning of when you receive value from this type of compensation versus your regular income or bonus can be critical in determining how much value you keep versus how much you pay in taxes. And again, this is really, like I said, kind of in that prior chart, how much are we paying on it? Again, depending on the income that we have in those years. So this is why having a plan ahead of time, now you know, and we can anticipate and do anything we can to offset those taxes. So I'm not going to go into a lot of detail on the specifics of these because we did in our webinar last month, so you can watch that as well. One of the really big things when now we're starting to look towards retirement at Allstate is really your pension. So those that qualify for the pension benefit, this is really one of the biggest decisions that you have. And the reason is because it can be a really meaningful amount that you have to take out. And so there's really two main options that you have with your pension. So you can either take it as a lump sum. And this means that you're going to take the total value of that pension that you would receive over your life. And they're saying you can take that full amount out and basically you roll it into an IRA, and then you pay taxes on those as you take the funds out. So you're now in control. You're really saying, I'm going to invest that so that I can have flexibility of when I have this money. The other option is you can take it out over the rest of your life, and they call this an annuity option. And this just means that your pension becomes an annuity for the rest of your life. You're going to get the same amount each month, depending on the option that you choose. And this is the option where you don't have to worry about investing it. You're just going to get a set amount for the rest of your life. Now, what can happen here is that maybe you won't, have enough money for the expenses you need when they come up, depending on what you're going to have. So we're going to talk about some of those benefits or risks with these two different options. All right, so let's talk about these two main pension options. So with the lump sum pension option, when you're choosing this choice, you're choosing to roll over the total pension benefit into an IRA in your name. So let's go through some of these benefits and risks specifically with each of these choices. So benefits to this option, you've received this lump sum amount and you've put it into an IRA in your name. This gives you complete flexibility for when and how you use the funds over your lifetime. So now you can choose how much you take out and when. Your spouse and or your heirs receive the remainder of any IRA balance that still remains at your death. So this is something where, again, because you've taken that lump sum, if you didn't spend all of it during your lifetime, there's still a benefit that can be received by your heirs or go to your spouse. And so this is nice because regardless of when you pass away, all of these funds are received by someone that you want to receive them. Again, another benefit is that you can invest these funds to grow over your lifetime. So this is nice because just like your 401k or any other investment accounts, these are growing so that you have even more funds to use over your lifetime from that growth that they're earning as well. Now, similarly, there can be some risks. So for example, you likewise do have to be careful of how much you withdraw, as you need to pay taxes on the amount that you have withdrawn. So when you take money out of an IRA, you have to pay taxes in that year that you take it out. So this is where, again, back to being sure that you have a plan. You need to be sure that you're withdrawing funds, you know how much you're able to take out, because another risk is that you could outlast these funds. So again, when you're not receiving that annuity payment and now you can take out as much as you want or as little as you need, the other danger of here or risk is that you could take more out or you could outlast your funds if you spent them and you haven't spent them responsibly. So likewise, that can also be a risk. And then also one of the risks is that it's just up to you to invest your funds so that they last for your lifetime. So again, you need to be sure that you know your risk tolerance, but also the growth objective that you have. Now, when we start to think of the other option where it's a pension as an annuity, this is where we're choosing to get a payment for the rest of our life. And this is very similar to the paycheck that we're getting from Allstate as an employee. So I'm choosing to get an amount every month. And so I just continue to receive that as long as I'm alive. So, some of the benefits of this choice are that you know the amount you'll receive per month for the rest of your life. It's considered guaranteed income. That's how you'll hear a lot of people talk about this. The risk is left to Allstate to invest your funds. So this is a benefit to you because now you don't have to worry about that. That's up to Allstate to make sure that those funds are there for you. You can choose various annuity options. So one of the benefits, is that there are a few different annuity options. You don't just have to receive it for your life. It can also be for your life. And if you were to die earlier, if you were to die, then your spouse can continue to receive that benefit. Or, you can choose a few different variations of that, or they could receive 50% of the benefit. Depending on the option you choose, you just receive a different amount each month. So again, it's up to you, but that is one nice way to make sure that there's always some guaranteed income for you and your spouse. But that's where the benefits end. Um, as far as the risks, one of the things is also that you don't live long enough to receive your full pension benefit. So when we talk about, we'll look at a chart here in a second, if I'm starting today and let's say I'm 65 when I retire, I really want to receive benefits for the next 30 years, 20, 30 years. So I'm getting that full amount that I had earned when I was working at Allstate, that full pension benefit. But one of the risks is that you could die before then. And if you didn't choose an option where someone else can receive that benefit, your spouse, then no one else is receiving that full benefit. So you really only received a portion of it. One of the other risks is that Allstate pension plan doesn't stay completely funded and you only receive a percentage of the benefit promised to you. Now, this is really rare, but I have seen it happen. One example of this was United, for example, where, pilots were receiving their pensions, employees receiving their pensions. And then it was cut by maybe 20, 30%, and because United went bankrupt. Now, one of the interesting things with a pension that should hopefully help you to feel at ease if you're choosing this option is that there is an organization called the PBGC, and that's the Pension Benefit Guaranty Corporation, and it's essentially insurance for a pension. And so what happens is that Allstate is, paying into this PBGC to make sure that your Allstate pension stays funded. So they're making sure that if anything happens, that's going to be insured. And at the worst case, that you would just receive, a cut in that amount, but you would still receive some type of guaranteed income. So again, there is essentially insurance for that. So even if you choose this option and the worst were to happen, there should always be some amount, even if it's cut by a percentage. And then one of the main risks is that you may need more funds than you're able to receive each period. So each month you're supposed to get, let's say, $5,000 from your pension, but in some months you might need more than that. And so again, this kind of just gives you that set amount. This doesn't increase with inflation. And so that's the amount you're going to get for the rest of your life, even while inflation is making your expenses more expensive every year. And so these are just things that you need to consider, just some more of the details. Now, one of the ways that we like to look at this with clients to really help you understand really objectively what is the best option for you is this chart. And here's an example of someone who's receiving their pension and they're getting ready to retire. They're trying to decide which choice do I take. Now, this person was going to receive, let's say, $775,000 in a lump sum pension benefit. That's this yellow line up here. And this is someone who says, okay, they could take the lump sum amount, and that's what that would be. Now you'll notice a lot of these other lines, all of the other lines, basically grow over time. And here's what's happening. Someone on day one of retirement who says, I'm going to take this lump sum pension option, is getting this full $775,000. So on day one, that's the amount they have in their IRA that they could spend. Now, someone who says, I'm going to take the pension over my lifetime, on day one, you've only received that first payment. Let's say that's $5,000. And then you get $5,000 the next month and the following month. And years 3, 4, and 5, you continue to receive that. So over time, the longer you live, then you continue receiving. And so now you can see how that benefit gets up to these same levels or very close to this pension, the lump sum amount. Now, what's interesting, and this is why you have to look at this for yourself, is that at different times, depending on interest rates, these lines can intersect at different points. What we're really trying to find, especially if you said, I want to take an annuity option, is we're really trying to find, obviously, the highest of these lines. And what you'll notice is here, when this person's like 86, 88, in the future, you'll see that some of these lines start to cross over others. And so some of the discussions or the things we'll talk about are, how long do you think you're going to live? What's your family history? What's your health like? These are some of the decisions or the factors that you need to consider when you're choosing what option do I take. And so again, what we're really trying to show you is kind of an objective on day one. And as you continue through retirement, how much have you earned or do you have? Now, what's interesting with this lump sum option, we're showing this again to really show you the objective kind of future value that you're going to receive. We're not showing this growing at, maybe 6.5%. Someone who doesn't need these funds on day one or throughout most of their life, they could actually just invest these and then that continues to go higher and higher. But we're really trying to show you the value of that lump sum pension in the beginning and then over your life. So we're not trying to kind of skew it so that it looks better, but you do need to understand that if you take this lump sum amount, you can invest that and that can continue to grow even further. So these are things that you just want to continue to look at. You want to look at, especially for yourself and based on your own factors to see, well, which option should I take? So these are things that we help clients with. And again, you can see down here, there's different options, whether you take it over just your life, whether you take it over your life and a spouse's life. That's how you start to see different monthly amounts that you receive. Maybe joint and survivor, so it's your life and your spouse's life, and you want them to receive 100% of the amount that you receive every month, even if you pass away. That's how you're setting the different amounts that you're going to receive each month. So that's how you have to look at this and consider, but hopefully this chart kind of helps to explain, really kind of what is happening over time with the annuity option versus that lump sum option. These years here in the end, these are just the years where we said, okay, these clients are now age 99. And so we're just saying, okay, maybe that's like the end of their life. So that's what those bars represent. I just wanted to explain those too. So there are some additional Allstate benefits that, again, when I say we kind of have this fresh set of eyes as we look at these, I want you to consider these a little bit differently too. So what we're going to touch on here, just a couple points, is to consider using any of these benefits that you'll need in retirement before you retire. So for example, Allstate has a legal plan benefit where you can get estate planning documents and other legal needs. But one of the things for someone retiring is that you do need estate planning documents in place. And even people who aren't retired need estate planning documents in place. But if you're someone who hasn't gotten them in place, or you did this a long time ago and maybe you want to get them updated, it's a great time to use this benefit before you retire to get these things in place so that you're able to do this at a reduced cost than what you might pay outside of using this employee benefit. Also, this health insurance and your HSA, it's really important to now coordinate the health insurance choice that you're going to make. So maybe you have health insurance available to you. Maybe you're going to be on the marketplace or Medicare, or maybe your spouse has a health insurance plan, a retiree plan, or maybe they're still working. You need to coordinate all of these pieces along with any funds that you've saved in your HSA and when you want to use those. So these are pieces that you do want to look at. You do need to consider of how, again, can I use these benefits to better my plan or to allow me to get something maybe at a reduced rate because it's a benefit to me as an employee and I still am an employee and I can use it before I retire. Now, one of the interesting things is, you might be looking to retire, and I could be talking to someone who is going to retire in the next 5 years, the next 10 years. And maybe you're someone who says, okay, I'm retiring and I'm almost 70, I'm in my upper 60s, but there could be some of you who say I'm retiring and I'm in my mid 50s. One of the things you have to understand is that using your benefits depends on the age that you're going to retire. In each of these examples, your 401k, that net unrealized appreciation, your pension, stock compensation, all of these pieces, is that it's very important to consider and look at how old am I going to be when I retire? When do I need to use these funds? How many of these funds do I need to use each year? This is the kind of thing that we need to really start looking at and considering over the rest of the timeline for retirement. Now, one of the charts that I always love to show people is really when you're doing that, when you're considering all of these pieces, depending on when you're going to retire, is this is an example again of someone retiring in the next year. So they've got really high income in this first year before retirement, and then they're going to have about 10 years where they're retired and they don't have any income coming in. And so what we are starting to look at are what are the strategies that we can use for them, which will change as your life does. But what's one strategy we could do? For them, it was doing Roth conversion. So is moving some money from their IRA, their 401k, early on while they're not working, early in retirement, we're moving some money from that IRA into a Roth IRA, and we're doing it in really low tax rates. What's happening now is instead of having all these high years of taxes later on in life because we didn't do anything when they were in a low bracket, now that we've done something and we've converted some of this money at lower rates, now we have a lot less future years where our taxes are even lower. So we have less years with higher taxes. And so that's where it's really important to see kind of the before and after. When you're doing ongoing planning, you can actually see the difference that this makes year after year. Now, when we're talking about using your employee benefits, one of the biggest things and what we're really trying to accomplish is to use your benefits to build long-term wealth for you in your financial plan. So when you're making a decision on each of these benefits, it's not that you're making them individually on your 401k or your pension in a vacuum. We're really needing to look at and coordinate all of these together, the investments you have, savings accounts, your pension options. And one of the biggest mistakes that we see Allstate leaders make is that they don't start planning early enough really to coordinate retirement income that they're going to receive. So one of the pieces, again, depending on when you're retiring, as you're considering that, it's you want to plan out when you're going to receive income and benefits so you can stay in the lowest tax bracket possible. That's really what we're trying to do so that you're keeping as much as possible. Now, one of the interesting things here is this can be really helpful for someone moving into retirement. It's helpful to really kind of look at your next 5 years cash flow. And this kind of helps you to kind of start to conceptualize, okay, I'm moving from getting a paycheck, having this income from working into retirement where I'm not going to have that paycheck coming from the same place. And so a lot of times what we will tell clients is that your paycheck isn't going away, it's just changing where it's coming from. So in this chart, what I've laid out here is really over the next 5 years, really the cash flow that this retiree, for example, was going to be receiving. At the top of here, what we always like to show is kind of like the next 5 years also of the investments. So this is someone who's retiring from Allstate. They've got a retirement account, in 2024, it's like 1.8 million. We're showing that's just going to keep growing, and we're using just kind of a 6.5% growth rate. Not a really aggressive portfolio, just something conservative. We're trying to now make sure these funds are here for you in retirement. So we're showing that growth continues. Again, this just helps us to see, okay, now in retirement, when I don't have a paycheck, now we're going to start to take money from these portfolio assets. So this helps us to be reminded that they're continuing to grow. We can see that balance up here. Now, as we move to the middle of the screen, this is where you'll see the salary and the income that this person was receiving. So the biggest piece here is that we have Allstate, that salary that was coming in, so right around 100,000, a couple years here before retirement. And now we can see in 2026, they're going to be retiring. And so now there's no income coming in. So really retiring at the end of 2025. And we start receiving zero income from salary from Allstate. in a paycheck. And so now we start to see, okay, this is real money, isn't coming from a paycheck that way. And so where is it going to come from? So now as we start to flow down here, we see we've got our expenses, everything we're planning to spend, whether that's property taxes, just regular everyday expenses, liabilities we might still have, like a mortgage, taxes, all of these pieces. So we've got all of these expenses year by year as well. What you'll notice down here is when we take our income each year minus the expenses, this shows us here while we were working, we had plenty of income to cover the expenses that we had. But then as we move into retirement, now without this employer income, we start to show a deficit. So we say, okay, well, I've got basically 65,000 of a shortfall that I need to make up from somewhere. The next year, it's about 70,000, 75,000 in the following year. And so you can see that as this continues to grow, or just that there is a deficit, we say, where is this money going to come from? Now, what's also helpful is at the bottom here, we're showing, look at the portfolio growth. So again, we had said this person has 1.8 million saved. So in their 401k leading up to retirement, that's how much they've saved. The growth on this portfolio, we're assuming in that year, is basically 121,000. So the next year, 133,000. So your portfolio continues to grow each year because it stays invested. Now, what's interesting here is you notice we had that deficit, or we needed to make up a shortfall of about 65,000, and our portfolio growth is almost 140,000. So you can see that our portfolio is growing well above what we actually need to take from it for expenses for that shortfall each year. This is one of the encouraging things that we see for retirees when they retire, is that the shortfall that they need to make up is usually well below the growth of their portfolio. And this does continue for several years. This is very common, but at some point, the inflation on your expenses does usually catch up. It can be well into your 80s where you'll start to see that, and then you'll start to see that maybe the expenses are more than the portfolio growth. So it's not until then that you're finally kind of dipping into this principle that you have. And so hopefully this is kind of encouraging to show you it's really not that you're changing, that you're not getting any income in retirement. It's just that we're changing where it's coming from. So it's not coming from a paycheck, it's just coming from your portfolio. And so you can see all of these happening at once and kind of seeing where it's coming from and how we start to make up that difference. This is where, every retiree is different. Some say, whatever my expenses are going to be for that year, I'd like to go ahead and put it in my bank account or a savings account, and then I'll spend it throughout the year. Some people say, I really like having kind of that income that was coming while I had my salary. And so can you deposit that every month, that amount that I'm going to need? And so it can be whatever you need it to be, but that's how we work with different clients to basically build that income in retirement. Now, this is where it really gets exciting, and we start to say, okay, we want to pair tax planning strategies together. And so these are just some common suggestions, and just a way, again, that I want to help you think about how you can use the benefits you have and pairing them at different times. So, for example, you might plan IRA distributions to consider windows where you could do Roth conversions to convert money in low tax brackets. That's where maybe you're retiring a little bit earlier, so you've got more years before your RMD start, which is as late as 73. In the next one, this next option, if you take the lump sum pension option, you can choose when your income starts. So if you had money saved outside of that IRA or outside of that pension, now you've got other funds you can use. This allows you to maybe do some Roth conversions because you've got low or no income in some of those early years. You can also use highly appreciated stock. So this is where I was talking about that stock that you had saved or purchased inside your 401k. Now you've rolled it out into a taxable brokerage account. And so you have this highly appreciated stock that's grown in value. And now, we've gotten it down to where there's only capital gains taxes that we're paying. But what if you like to give charitably every year and you want to continue to do that in retirement? Now you could even use that stock. So instead of giving money to those organizations just from your checking account, we can actually donate some of the shares of this appreciated stock. We donate that instead of cash, and now we pay nothing in capital gains tax. Now we've completely wiped out any tax that we're going to pay on that because we're just gifting those shares in whatever amount you want to kind of match the amount you're wanting to give in that year. We're gifting those shares to that organization, and now we're actually getting a deduction for that charitable donation, but we've given it in stock, so we've completely wiped out any taxes we had to pay on those. Now, that's something that you might want to do early in retirement, for example. But then later in retirement, this next bullet point, you might want to use your IRA. So once you reach age 70 and a half, you can use your IRA for that charitable giving because then you don't pay taxes on those distributions when they're sent directly to those charities. And so again, this is a way we can minimize some of these taxes that you have to pay by also accomplishing the goals or the things that you want to do or the expenses that you're going to have each year anyway. So one of the things that we're really doing is we're timing retirement income right, such as Social Security, pension, retirement account withdrawals, all of these things we've talked about. We're really pairing and timing all of these so that you can save as much as you can in taxes. So I just want to kind of highlight, these are a lot of the ways, when you think about your financial plan, we've talked specifically about your Allstate employee benefits that you have, but there are so many other things that you want to also think about. So this is just a chart of all of the ways that we help clients as they're considering their financial plan. Other things that might impact it, you could be nearing retirement and still, needing to fund college. It's pieces like that that, again, we're coordinating together. So I just like to show this as an example for people who say, what other things should I be considering? These are the ways that we help our clients when we're helping them as a near retirement. So again, like we talked about in the beginning, retirement is the journey to and through the rest of your life beyond your working years. So once you've reached retirement, it may be a mix of emotions, but hopefully that journey to and through the rest of your life can be smooth, even beyond your working years. And that's really what we're trying to accomplish and do well. All right, so I do think that we've gotten a few questions that I want to be sure and cover. So we're going to answer those really quick and then we will be done. All right, so the first question that I saw come in, do you see any of these benefits expiring in the near future? Or how often does Allstate change these benefits? I don't want to rely on one just to have it changed right before retirement. That's a really great question. So when we think about employee benefits, it's very common that companies, Allstate included, may change frequently, maybe as frequently as every year, like health insurance options, things like that. That's something that they might change, or 401k investment options. But usually big things like having a pension, not having a pension, 401k thing, 401k plan, having one, not having one, pieces like that. Those are very big events. And even if you have been working at Allstate, you've earned a benefit, you've earned those things already. So even if they were to change something or do away with something, and you would be notified of that, and you would know if you qualify or don't qualify. But as long as you've been there and you've earned a benefit already, that is something you've earned, and they usually will pay. Even if they stop, like the pension plan, for example, they may just stop new people coming into the plan, but that doesn't mean that you won't receive the benefits that you're eligible for. So that is a good question. Benefits like that, those really big benefits that you're depending on, those are ones that do not change frequently. Those are a really big deal when they change. There's a lot that goes into that, and it affects a lot as well. So it's something that does not get changed very frequently, such as, medical insurance, things like that. The next question, how are pensions taxed differently between annuity and lump sums? So that's a really great question, and some specific points that I didn't touch on in the slides. So when you choose your pension, that lump sum, you're taking money, you're rolling it into your IRA. That is not a taxable event. So you don't pay any taxes when you move that money from the pension to your IRA. That just comes out, it rolls over. Now, you need to be sure, because today they still do send checks for that amount. So they can send checks, that a pension amount, for example, may come as a check to you that you then need to deposit into your IRA. Or the same, your 401k, when you're rolling that into your IRA, they may send a check that you then need to deposit into your IRA. When you do that, you need to be sure that once you get that check, that you do deposit it into the IRA as soon as you can. So there is actually a 60 calendar day window where if you don't deposit it within that time frame, and you receive the check but it's just sitting at home for a month because you went on vacation and never got deposited, it actually becomes taxable. So now you're paying tax on that entire amount, and that is something that you want to completely avoid. So you need to be sure that when you're doing these rollovers of the lump sum pension, the 401k, that if it can, sometimes it can go electronically to the custodian of your choice. So if you're moving that to Charles Schwab, for example, that pension may go directly into there, but your 401k, for example, may come as a check to you that you then have to deposit. So you just need to be careful and know that rule. But from that lump sum, when you're moving those funds and you're rolling them over, there's no taxes that are due at that time. The annuity, when you start to receive those payments, you pay tax on it just like you were with your paycheck. So as you earn those funds, then that's when you pay taxes in that year that you earn it. And so that's what you pay when you do your tax return the following year. Okay, the next question. You say the biggest mistake is people don't plan early enough. What's the latest someone could get started coordinating their benefits before their retirement date? Yeah, that's a great question. Well, I would say the latest someone could retire or could start coordinating their retirement benefits is, you can wait as long as, your decision that you have to make. So for example, up until the time that you've made your decision of how you're going to take your pension, or if you're going to move your 401k, you can change your mind, up until that time. But once you submit that 401k decision, or that lump sum pension or annuity pension decision, once you've selected that, you can't change it. And so I would say that that's really the latest, is up until the time that you have to make those choices. That's when you could do that planning. There are times where we will have people that are ready to retire, and we can do that plan. We put that together and then we say, okay, now that they're confident in it, then we say, okay, now we go ahead and make those decisions. Really, once you've made those decisions, like I said with the pension, there isn't a redo button. You can't change it once it's started. So that you do need to be cognizant of that, you can wait as long as you want. Some people are really confident in the amount that they've saved for retirement, and they don't feel like they need to plan for a long time. But also there are people who, are younger and they want to be sure that they're able to take advantage of some of these tax planning opportunities. So I would say it's not too late until it is. All right, and then the last one, how do I work with Allstate to make these decisions and switches with my benefits? Leading up to retirement, when you're making these decisions and they know you're going to retire, you'll be sent, information, whether that's via email and instructions. When you're logging in to see pension estimates and stock information, all of those, all of that information is available. It's all written. There's a lot of information in supporting documents with those. So, as we've worked with clients over the years, we're very familiar with, because we've helped several people retire from Allstate, that we're very familiar with the decisions you need to make. Even when you're choosing your pension, whether that's a lump sum or annuity option, you need to have that information in, a month or two before you're actually going to receive that first payment. So this is where you have to set up that financial institution information of where you want that sent prior to when you start receiving the benefit. So, but by a month. And so it's very important that you actually have that information entered. Again, so if you have someone that can help you, whether that's a benefits coordinator or you're logging in, or just, I would say, be very thoughtful and cautious, and be sure to read everything that you're sent, because that's really where you'll find a lot of these answers, is in the choices that you're being sent. They include all of the different things that you can choose as well. All right, so thank you for tuning into this webinar. I hope this is really helpful. We do have some next steps. If you say, you know what, I really want some help walking through planning for retirement from Allstate, you can easily schedule a consultation with our team. So that's my email, michelle@financialdesignstudio.com, and I can help you get that scheduled. You could also go to our website if you want to learn more information about our firm, and you can choose Get Started if you're ready to maybe start looking at what that looks like. We'll make sure that you're a good fit and that we can help you with the questions that you have. Beyond that, if you want to dive deeper into your benefits, you can watch that webinar, Maximizing Your Allstate Benefits and Executive Compensation. We're going to link that in the recap email after today's recording, along with the recording. But you can also share this webinar. So we've linked to the prior webinar from a month ago, and then you can also watch this one and share these as well. So I hope this has been helpful. We're excited for you as you start to think about your retirement after Allstate, but there's a lot of great benefits that you can take advantage of. So thank you for joining us today. I hope this gets you started as you think about your journey ahead.